A very good morning to all of you students. Today we will continue with the topic on advanced capital budgeting and do lot of questions for the concepts that we have already studied in our previous two sessions. Good morning, Gurram. So yeah, let's start with question number 13. This is from our assignment and we will do the revision of concepts along with the question. Okay. Skylark Airways is planning to acquire a light commercial aircraft for flying class clients at an investment of rupees 50 lakhs. The expected cash flow after tax for the next 3 years is as follows. So this is a question on Skylark Airways. They're planning to invest rupees 50 lakhs for the purposes of a aircraft, and they have given us the next 3 years cash flow in such a manner that for every year there are different probabilities of getting the cash flow after tax. Just a second. Good morning, Viraj. Good morning, Manjunath, Devansh, Shailesh, Robin, Ganesh Kumar. So in this question, we have been question. I'm talking about question number 13. Just allow me a one more minute. Yes. Good morning, Mansha. Good morning, Suraj. So yes, we started from question number 13. So we have read till year-wise cash flows. Now, what is the requirement here? The company wishes to take into consideration all possible risk factors relating to airline operations. Hence, the company wants to know the expected NPV of this venture assuming independent probability distribution with 6% risk-free rate of interest. So students, what do you mean by independent probability distribution? Independent probability distribution means that in year one, there are chances that 10%, 20%, 40%, and 30%, the probabilities that are mentioned, any of the chance can come and they have the respective probability. Then in year two, again 10, 30, 40, 20, anything, any option can come. So year 2 is independent of year 1. Similarly, year 3 is independent of year 2 and year 1. So there is no correlation between year 1, 2, 3. Okay. So it's not like that in first year if we get this 10%, so in second year also we will get 10%, and in third year also we will get 10%. It's not likely the case. That is what this independent probability has actually meant. So students, let's start with the solution. Then there are two more things that we will study and then accordingly answer. First of all, let us calculate the expected NPV. So for calculating expected NPV, we first need to put year-wise what is the expected NPV. So we are doing this calculation in, let's say, rupees and lakhs, right? So year 1, cash flow, probability, and then cash flow into probability. Year 2, cash flow, probability, and again expected cash flow or cash flow into probability by whatever name you want to call. Then similarly, year 3, cash flow, probability, and cash flow multiplied by probability. So for the first year, what is the cash flow in lakhs? 14 lakhs. What is the probability of it? 10%. And hence 1.4 is the 1.4 lakhs is the cash flow into probability. Second, 18, 20% is the probability. So 3.6 is the amount. Similarly, 25, what is the probability? 40% probability, and hence 10 lakhs is the expected cash flow. Similarly, for the fourth observation, it is 12 lakhs, and the summation would be equal to 27 lakhs for the expected NPV for year 1. Similarly, for year 2, 15 lakhs, 20 lakhs, 32 and 45. And the probabilities are 10, 30, 40, and 20. The expected NPV will be 1.5, 6, 12.8, and 9. The total comes as 29.3. Similarly, for last year, 18, 25, 35, and 48. And the probabilities are 20%, 50%, again 20%, and 10%. So it becomes 3.6, 12.5, 7, and 4.8. So the total comes as 12.9. This is 27.9. Now, expected NPV for the respective years we have calculated. We can calculate now, sorry, this is the expected cash flow that we have calculated, correct? Now from this expected cash inflow, we have to arrive at NPV. So the NPVs are 27, 29.3, and 27.9. The present value factor at the rate of 6% is 0.943, 0.890, and lastly 0.840. The total present value will be 27 multiplied by 0.943, which is 25.461, 26.077, and 23.436. So the present value of cash inflows is straight away the summation of this, which is 74.974. I think till here, there is nothing specific in the question to answer, right? We have just calculated the probability wise expected NPVs and accordingly calculated the present value of cash inflows. So less present value of cash outflow, which was how much? 50 lakhs. And hence the NPV, the expected NPV, we can say it is 24.974. I hope it is clear till now. Now let's go on to the second part. The possible deviation in the expected value. What do you mean by the possible deviation in the expected value? This is called as standard deviation. Simple. Because the definition of standard deviation itself, it says that what are the possible deviations from the expected value. So now let's calculate the possible deviation from expected value. What is the expected value? 24.974. Now for calculating the possible deviation from expected value, we have to calculate standard deviation. For calculating the standard deviation, we have to calculate all the observations minus the expected mean of that particular year and multiply with the probability. Correct? That is as per the formula again. So year one. Year one, what will be my x minus x bar? So x bar here refers to the expected cash flow of one of the first year. Correct, students? Because we always calculate it from the best possible outcome, which is the x bar. So just to elaborate, 14 minus 27, 18 minus 27. Now from where this 27 has arrived? 27 has arrived, students, from here, which is the expected cash flow from year one. Okay. 18 minus 27. Similarly, 25 minus 27. Similarly, 40 minus 27. So this comes as how much? This comes as minus 13, minus 9, minus 2, and then 13. Then we have to calculate x minus x bar square, because we have seen, and I've given the logic also why we do a square of this deviation, because minus 13, if we take as is, it will offset this plus 13. So to avoid that and to see what is the absolute deviation, we take a square. Correct? 169, 81, 4 and 169 again. Then we will multiply it with the probability. Correct? Whatever the respective probabilities are. So 169 into 10%, which is 16.9. 81 into 0.2, which is the respective probability of that observation, 16.2. 4 into 0.4, 1.6. 169 into 0.3, which is 50.7. So the total comes as 85.4. Okay, students? Then the standard deviation will be 85.4 square root. Why? Because this is computed as variance. Okay, students? This is computed as variance. So it comes as 9.241. So this is the standard deviation of the first year. Similarly, I'm not repeating the calculation for standard deviation of second and third year. Okay, because there are a lot of questions we have to cover today. So hence, standard deviation of second year, the variance is coming out to be 98.61. And for the third year, the variance is coming out to be 74.29. This is 8.619 and this is 9.930. Till now, students, I hope all of you are there with me. Yes, so Mansha is asking, sir, CF80 is estimated cash flow. We obtain expected cash flow after multiplying with the probability. Yes, Mansha. So the expected cash flow, you will get it after multiplying it with the probability. Robin is asking, sir, in the given question, the company want to consider all risk factors, but risk-free rate is given. So that is true, Robin. But we have to solve it basis whatever facts that are given in the question. Okay. Tanisha, good morning. Kusuma, thank you. Perfect. So we have calculated for the respective years, whatever is going to be our standard deviation. Now, students, since this question has specifically specified that the probabilities have an independent, the probabilities are independent and they have no dependency on year 1, year 2 and year 3. Hence, we will just simply calculate the standard deviation for the project now, right? We have to calculate the standard deviation for the project. So the standard deviation about the expected value will be, now we have to take the standard deviation and take into account the present value factor, right? So 85.4 was our variance. So we have to take the respective years variance and take a summation of it. So this comes as okay, students. So the standard deviation we have to take across the entire life of the project, which is the 3 years that has been given to us, and accordingly calculate the total standard deviation. So in this formula, what we have just done is we have taken the individual years standard deviation and taken a present value factor also. And the reason why we have taken square into 4 raised to the power 4 and raised to the power 6 is because the probabilities are independently over the period of project. Because of this line, there is an independent probability distribution. Okay, students? Yes, Mansha, standard deviation is this standard deviation is for all the 3 years. Now to just put it simply, what was your expected NPV? Expected NPV was it was how much? Expected NPV? Sorry, 24.974. So the possible deviation can be plus minus 14.369 6. So in a way, it can be higher or it can be lower by 14.3696. Okay, so that is the essence. Now, what is the third part of the question? So the third part of the question is how would standard deviation of the present value distribution help in capital budgeting decisions? So this is, I think, more of a theoretical question. So we can mention that for calculating the possible deviation in the expected value, standard deviation is used as a statistical measure of dispersion because it measures the deviation from the central value, that is mean. Correct. And as I told you that in this case, we have a clear answer that although your best possible expected NPV is 24.79974, however, with the standard deviation, we can say that the upper and the higher range will be plus minus 14.3696. Further, we can also add to our knowledge from the coefficient of variation, since we have both standard deviation and mean here. This is mean and this is standard deviation. What is likely to be the correlation of co correlation, sorry, coefficient of variation? Okay, students. So Uday is asking from where 1.06 comes. 6% is the rate of interest. Hence, you have to discount it at the rate of 6%. That is where from 1.06 has come. Okay, students. Can we take present value while calculating variance? Mean. Yes, Manjunath, we have taken present value here. While we have taken the final formula here, we have taken the present value here. Okay, students. Now let us move on to the next question because we have a lot of questions to cover, students, today. Okay. Yes. So question number 14, a company is considering projects X and Y with the following information. What are those following information? Project X is having an expected NPV of 1,22,000 and a standard deviation of 90,000. Correct? X is there and Y is there. And for Y, the expected NPV is 2,25,000 and standard deviation is 1,20,000. Which project will you recommend based on the data above? Explain whether your opinion will change if you use coefficient of variation as a measure of risk. Which method is more appropriate in this situation and why? No, so Mansha is asking in the previous question, can we use straight away 1.06 raised to the power 1, raised to the power 2 and 3? No, you can't do that because the probabilities are again independently correlated. We will do one more question, then we can draw some comparison where the probabilities are dependent and hence we can use that formula then. Okay. Now, first of all, students, this is a very simple question. So it is asking us to say that which project will be recommended. So purely on the first part, we cannot apply our coefficient of variation because definitely it is asking in the second part. So first part, we will have to use, let's say, the comparison between standard deviation. So the comparison between standard deviation says that X has a lower risk, correct? So we can say that on the basis of standard deviation, project X can be chosen as risk is lower in project X. Okay. Then the next question, explain whether your opinion will change if you use coefficient of variation. So let's calculate coefficient of variation. Very easy and very simple, students. How will you calculate the coefficient of variation? So coefficient of variation is given by standard deviation divided by mean. So 90,000 divided by 1,22,000. So this is how much? 0.738. This is for project A. Similarly, project X and Y. Y will be 120 divided by 225, which is 0.533. So students, coefficient of variation is lower for project Y, which is 0.533, and hence on this basis, the project X appears to be riskier, more riskier, right? And hence we should accept project Y. Project Y should be accepted as coefficient of variation is lower, which means that project Y project Y have lower risk for 1 unit of mean. Perfect, Manjunath. Manjunath, the expected net present value we will use in the third point. So let's come there. More appropriate in this situation. See, the most appropriate way in this situation is that we can just go with the expected NPV, because in this question we are trying to evaluate this decision at a point in time. So wherever extra amount we will get as NPV, that is the most appropriate solution. So Manjuna, your answer, the projected expected NPV is 2,25,000 of SD, then our earnings will be more compared to project X. We will use that in the third, that perspective we will use in our third option. Okay, Manjunath? NPV method can be used in such conflicting situations because NPV method is in compatibility of the objective of wealth maximization. Correct, students? In terms of time value. Now, students, why we are using NPV method here? Because ultimately using this method, the earnings per share will be the highest. Correct. Although there is a risk, although coefficient of variation is giving us something else, or the first method checking purely based on the standard deviation is also giving us something else. But NPV is ultimately how much cash, incremental cash, we are able to generate. Hence, we are basing our decision on the basis of third method. Okay, students, let us move on to the next question. Shivam Limited is considering two mutually exclusive projects, Project A and Project B. So these two are exclusive projects. Sorry. Project A costs 36,000 and Project B 30,000. Okay, students. So the cash outflow of Project A is higher compared to Project B. You have been given below net present value probability distribution for each project. They have given us the NPV estimates. Now, students, please note, here we have been given NPV itself. There is no cash flow involved. There is a complete NPV that is given to us. See the way questions are changing, because in the previous to previous question, we have been given the cash flow after tax. Now here NPV itself is given. Compute the expected net present value of the projects A and project B. Simply we can multiply. We will get the expected net present value. Let's do it quickly. Expected NPV project A, project B. It will be 15,000 into 0.20, 12,000 into 0.30, 6,000 into 0.30, and 3,000 into 0.20. This will be 3,000, 3,600, 1,800, and 600. So the total is 9,000. Similarly, for project B, the observations are 15,000 into zero point 0.1, which is 1,500. Then 12,000 into zero point 0.4, 4,800, 6,000 into 0.4, 2,400, and 3,000 into 0.10, which is 300. Okay, students. So this comes as 9,000 again. So both of them are coming as 9,000. Yes, Uday, it means project Y. Because project Y in the previous question, because project Y was yielding higher returns. Okay, absolute higher returns. Now, what is the next part? The next part, it is saying us to compute the risk attached to the each project, that is standard deviation of the each probability distribution, which is very easy. So the way risk has to be calculated, first deviation, then multiplied with the probability, and we have to take the square of that deviation. So let's calculate SD of project A. We'll just simply put the observations. Probability was how much? 20%, 30%, again 30%, and then 20%. Then project X, sorry, in project A, the X observation was how much? 15,000, 12,000, 6,000, and 3,000. So the X minus expected value will be how much? Expected value was 9,000. So 15,000 minus 9,000 is 6,000. 12,000 minus 9,000, 3,000. 6,000 minus 9,000 minus 3,000. 3,000 minus 9,000 minus 6,000. So in this, we will multiply probability with X minus expected value square. Correct? This is whatever formula for standard deviation is. So 6,000 square multiplied by probability of 20%. So I'll just mention here 6,000 square multiplied by probability of 20%. So the value will be 72 lakhs. Similarly, here it will be 27 lakhs. For the third observation, it will again be 27 lakhs. Last one, it also be 72 lakhs. So the total comes as 1 crore 1 crore 98 lakhs. Okay. So the SD for A will be under root of 1 crore 98 lakhs. Correct? We till now we have calculated the variance. Since the question is asking for SD, hence we have to take the under root. So this is 4450. Now similarly for project B, we have to calculate the standard deviation. We will do the same calculations again. First we'll put the probabilities 10%, 40%, 40%, and 10%. So then next one will be value of X. The observation value 15,000, 12,000, 6,000, and 3,000. Then X minus expected value will be how much? 6,000, 3,000, minus 3,000, and then 3,000 minus 9,000 will be how much? Minus 6,000. Okay. Then we will multiply with x minus EV raised to the power square. Correct? So this will be 36 lakhs, 36 lakhs, again 36 lakhs, basis the calculation, then again I think 36 lakhs. For all the four observations, it is coming out to be 36 lakhs by coincidence, and the total is 1 crore 44 lakhs. Standard deviation becomes as under root of 1 crore 44 lakhs, which is 3795. Perfect. So this is the standard deviation for project B. This was for A. Okay. I hope till here we are clear. So there is a question from Mancha from the previous question. Why we go with project X? So, okay, let's first finish this off, then I will take it. No, Shruti, it's not like that. I'm totally fine. Yes, so question number 14. See, finally, we have finally gone with project Y because absolute terms expected NPV is highest. So you have to analyze it that if project X is giving you 1,22,000, but project Y is giving you 2,25,000. Don't you think project Y is more EPS accretive, will contribute more to the wealth of the shareholders? Hence, finally, we have gone with the project Y. Okay. After all our analysis on, let's say, standard deviation, coefficient of variation, we have chosen project Y. Now, the next part here is compute the profitability index. So I think profitability index, students, you would have studied in your inter that how to calculate that. What is the formula for profitability index, students? So profitability index is given by discounted cash flows divided by initial outflow. Correct, students? That is how we calculate the profitability index. So do you have the discounted cash flows? No. Do you have initial outlay? Yes. But instead of discounted cash flow, what do you have? You have a NPV. So if you add NPV in the initial outflow, you will get the discounted cash inflow, right? Project A, project B. What is our expected NPV of project A? 9,000. Yes, Mansha, you're right. Present value of cash inflows divided by present value of cash outflows. Uday is saying higher the risk, higher return. Yes, Uday. That is one of the implications coming out from that question. 9,000 plus 36,000 divided by 36,000. 36,000 was our cash outflow. So our cash outflow plus NPV will give us the cash inflow, right? So this is 45,000 divided by 36,000. It comes as 1.25. Again, 9,000 plus 30,000 whole divided by 30,000. So this is 39,000 divided by 30,000 gives us 1.30. Okay, students. So the profitability index is calculated accordingly. Very easy and very simple, students, till now. Then last one, which project do you recommend? State with reasons. So they're asking us now, which project would you recommend? So now, students, we have expected NPV, which is 9,000 in both the cases. We also have standard deviation. One standard deviation in project A is higher and standard deviation in project B is lower. Correct? So risk is lesser in standard deviation B. So hence we will definitely go with the project B. Correct? Project A and B are giving equal NPVs. That is 9,000. However, risk in project B is lower as compared to risk of risk in project A. Risk of, we can mention, risk of project B is lower as compared to risk of project risk of project A. Okay. Hence, we should go ahead with project B. Yes, Tanisha, your answer is correct. 1.25 and 1.30. Okay, students, I hope the concept is clear. Now let's move to the 16th question. This is also one of the important questions. Following are the estimates of the net cash flows and probability of a new project of Messrs. X Limited. Initial investment, there are 30%, 50%, and 20% probabilities. And in all the probabilities, initial investment remains same, which is 4 lakh rupees. Then estimated net after tax cash inflows per year is 1 lakh, 1 lakh 10,000 and 1 lakh 20,000. So 30% chances you will get a minimum cash flow of 1 lakh, 50% chances you will get a cash flow of 1 lakh 10,000. Sorry, students. I think you have to go to question number 16 years. And then 20% chances you will get the highest cash inflow of 1 lakh 20,000. Then estimated salvage value is also given. The required rate of return from the project is 10%. Okay, students? Okay. So first, the expected NPV of the project. Easy and simple. We have to just multiply with the respective probabilities and arrive at the NPV. So solution will be, we can go year by year, 0, 1, 2, 4 we can put, then fifth year we can put because of the salvage value. So first year, whatever is the probability, 4 lakh will remain same into 1, correct? So the net cash flow is 1 we can take. Probability, sorry, present value factor we will do, and then this present value factor will be at the rate 10%, and then finally the net present value. Okay. So 4 lakh into 1 will remain 4 lakh. Present value factor for the 0th year will be 1. and hence it will be minus 4 lakh because of the cash outflow. Then first to fourth year, how much we will get? 1 lakh, there is a probability of 30% plus 1,10,000, there is a probability of 50%, I guess. Yes. Then another 1,20,000, there is a probability of 20%. So this is the probability multiplied cash flows, yes. And hence it comes as 1,09,000. The weighted average cash flow for these probabilities, and the present value factor at the rate of 10% for first to fourth year is 3.170. Correct? And hence it, if we multiply these two, the amount comes as 3,45,530. And the fifth year, we will get two cash flows. One is the regular cash flow of 1,09,000, correct? Plus, now what are the different salvage value? They also have the different amounts, right? So 20,000 multiplied by 0.3 plus 50,000 multiplied by 0.5 plus the last option is 60,000 multiplied by 0.2. Okay, so this comes as how much? 1,52,000. 1,09,000 we will take the basic cash inflow. So the sixth year 10% present value factor is 0.621, and hence the amount comes as 94,392. The total comes as NPV is equal to 39,922. Very easy and very simple till now, students. No, Shruti, just check once. No, cash flows are not for 3 years. Cash flow is from first to fifth year, Shruti. So there are three different probabilities in which they have distributed 30, 50, and 20. Okay. But cash flows are for first 5 years only. Mansha is asking in previous question, we first obtain the expected value and then multiply it with the if the cost of capital to get expected NPV. But here we are given the NPV. Yes, in this question we were given the NPV. We have directly multiplied with the probability to arrive at the expected NPV. Because in the previous question you were given cash flow after tax. So for arriving cash flow from cash flow after tax to NPV, first you have to arrive at the expected cash flow after tax. Then you have to multiply it or divide it with the cost of capital. Okay. Now students, the next part. The best case and the worst case NPVs. Students, what is the worst case here and what is the best case here? Can anyone attempt? What do you mean by the worst case and the best case? This is something to do with the scenario. So in a way, you have been given three different scenarios with the three different probabilities. So can anyone of you tell me what will be the worst case and what will be the best case? So there are three cases, right? So this is case one, case two, and case three. Please answer, students. What will be the worst case and best case according to all of you? Yes, students, come on. So, what is the worst case and the best case? Is it the first, second, or third? So, the best case or worst case, you will see basis the probability or basis the outflows. So, Devansh is saying first case is the worst case, and Shailesh is saying second best, rest worst. Okay, okay, perfect. Can anyone else do anyone does anyone else also have some other answer or some other thoughts? Please do share, students. See, there are two ways to think about it, right? Some of you might think that since the probability is highest in the second case, it might be the best case, and the probability is lowest in the third case, it might be the worst case. Or whether you want to put the best case or worst case basis the cash flows. Now, yes, I have more answers. Tanisha is saying worst case, least NPV and highest outlay. Case 1, okay. And best case, highest NPV and least outlay, which is case 3. Perfect, okay. Devansh is saying third case is the best case. Guram is saying best case 2, worst case 1. Okay. Uday is saying when the probability is 0.2, it is the worst case. Okay. Uday is trying to relate it to the probability. Mancha is saying, okay, Mancha has given, I think, the answer also. Okay, worst case. Perfect. Now let me bring in some clarity. So students, here worst case and best case is actually an outcome of the amounts and not the probability. Okay. So in a way, our worst case is this because the lowest cash inflow 1 lakh is there in the case 1, and similarly the lowest salvage value also. Okay, students, and similarly the best case will be the third case. I think there was one question in between. Viraj is asking why we have added 1,09,000 in the estimated salvage value. Viraj, see, we have taken 1 year to 4 year, then fifth year also you will get this 1,09,000, the basic cash flow, right? And this is the salvage value, and this is the basic cash flow that you will get, right, students? Okay. Now let us calculate worst case NPV. Okay. Worst case NPV, which will be 1 lakh. The present value factor for 5 years at the rate of 10% is 3.790. So this is 3,79,000. Then 20,000 is the salvage value at the rate of 6 to 1. This is 12,420. Correct. And minus cash outflow, we can say, is how much? 4 lakh rupees, right? So this comes as minus 8,580. This is the NPV of worst case. Similarly, best case. So, okay, let me just put in like this. Yes, in the next part, we will put best case NPV. What is the cash flow? 1,20,000. Correct? 1,20,000 into 3.790, whatever that value comes out to be. Then 60,000 is the cash flow from salvage value multiplied by 0.621 and 4 lakh into 1, which is a minus number. So the total comes out as 92,060. This is the NPV of best case. Okay, students. Then the next part of the question says the probability occurrence of the worst case, the cash flows are perfectly dependent over time and independent over time. So there are two things that we have been given if they are dependent or independent. So independent means that if point 0.3 comes, okay, let's try to attempt this question itself so that from the answer I will explain. So first of all, students, they are saying that which case we have to take? Worst case, right? If the worst case are there, then it is saying that in the first year also it will come, second year also it will come, third year also it will come, like that. And it is perfectly dependent over time. So that means there is a 30% probability that the cash flows will be the worst case. Simple, right? Because if in the first case the worst case happens, in the second year also the worst case will happen, in the third year also the worst case will happen. That is why it is perfectly dependent over time. Okay, perfectly dependent over time. There is a 30% probability, correct, for getting the worst case scenario. Now if they're independent over time, so in the first year there is a 30% chance, then again in the second year, out of that 30% there is another 30% chance, and in the next year out of that 30% there is another 30% chance that the worst case will come. And hence for independent independent case, 0.30 in first year, 0.30 in second year, 0.30 in third year, fourth year, and fifth year. Correct. So this comes as 0.00243. Okay, students, I hope the understanding of independent and dependent over time is clear to all of you. Now, the next part is standard deviation and coefficient of variation, assuming that there are only three streams of cash flow, which are represented by each column of the table which is with the given probabilities. Okay, so now we are required to calculate the standard deviation. So students, in this case, we have already calculated. There are two different, we have already calculated the worst case and the best case NPV. So we have to calculate the base case NPV, the middle case NPV. Then we are good to go with the calculation, right? So the base case NPV is minus 4 lakhs, outflow, present value of inflow 1,10,000 multiplied by 3.79, and 50,000 is the cash flow on account of salvage value 6.21. So this comes as in totality 47,950. Now students, if you see the question has specified that assume that there are only three possibilities, how will you arrive at the standard deviation? Correct. So for that, we have to first calculate the expected NPV of the entire project. So for expected NPV of the project, 30%, 50%, and 20% chance, right? There are three chances. What are the different NPVs? 50% we just now calculated, 47,950. 30% is the worst case, which is minus 8580. And the 20%, which is the best case, 92,060. Okay, students. So the total here is 39,813. This is the expected NPV. ENPV. Correct? Now we have to calculate the standard deviation from this expected NPV. We have this value as mean. We have these different values as possible values, correct? We have to calculate the standard deviation along with the probabilities. So the standard deviation will be given by, first of all, we will take the first value minus 8580 minus 39813 square, multiplying with the probability of this observation, then plus, what is the second observation? 47,950 minus 39,813 square. What is the probability for this? 50%. Then lastly, I'm just writing it down. 92,060 minus 39,813 raised to the power 2 again, and multiplying with the probability of 0.20, taking a square root of entire number. Correct? So the standard deviation here comes out as 35,800. Can we calculate the coefficient of variation? Yes. We have standard deviation. We have mean. So 35,800 divided by 39,813. This gives us 0.90. So the coefficient of variation is 0.90 and standard deviation is 35,800. This is what has been asked in this part. Okay, students. Yes, Shruti, give me a moment. I will explain on the independent one. Okay, Tanisha, I think the same question, dependent and independent, I will explain it again. No, Suraj. See, okay, Suraj, I'll answer to your query as well. First of all of you focus here. I will take up these queries then. Okay. See, students, okay, let me first explain the independent and dependent. Okay. Now, I request everyone to please focus here. See, this is year 1. This is year 2. This is year 3. This is year 4. And this is year 5. Okay. Now, if I try to make a decision tree here, let's assume for a moment there are only two possibilities, best and worst. Okay, let me take all the three possibilities that are there. And there was a base case also, right? There were three possibilities that were given in the question: 30%, 50%, and 20%. So they have asked us to go with the worst case, right? Now, worst case again can lead to three possibilities in the year 2: best, worst, and base. Base, I'm trying to say that 1,10,000 option, the option with 50% probability. Okay. Now again, worst will go with 3 Options in year 3. This is year 1, year 2, similarly year 3. This is again worst. It will again go, it can again have three possibilities like this. Similarly, base will also have three. Here also it will have three. Then again it will have three. So you can imagine there will be multiple possibilities, right? If you try to construct a decision tree. But this analysis of decision tree is only valid if the cash flows, if cash flows are independent. What do we mean by cash flows are independent? Cash flows are independent because in the first year, anything can come, best, worst, base. And in the next year, even if the worst comes, there is a chance that best also can come. And there is a chance that worst also can come. And in the third year, even if let's say the best comes in year two, in the year three, then again there is a chance that the best, worst, and base can come. So everything has a equal chance. Equal chance means 20%, 30%, and 50%, whatever is mentioned in the question. Because of that, now if I ask you for the entire 5 years, tell me the probability that worst case will come, what you will tell me? That for that to happen in the first year also, it should be 30%. And in the next year also, it should be the 30%. And in the third year also, it should be 30%. Fourth year, 30%. Last year, 30%. Then only I can tell you for all the 5 years put together, I will get the worst case probability. This I have explained for the independent cash flows. Now think it from the perspective of dependent cash flows. What do you mean by dependent cash flows? Dependent, sorry, dependent cash flows. What do you mean by dependent cash flows? Dependent cash flow will mean that if in year one there is a worst case cash flow that has come, which is having a 30% probability, then year 2, year 3, year 4, and year 5, it will continue. That's why it is dependent, right? There is no other chance that in the second year, the best case or the base case will come. Because second year cash flow is dependent on first year. Since already in first year, 30% cash flow of the worst case has come. Hence, in second year, third year, fourth year, fifth year, it will come in the sequence. It will come in the same sequence. Hence, the overall probability for the 5 years will be 30%. Okay, students, I hope this is clear. Why we have taken 30% and 30% multiplied by 5 times for independent and dependent comparison. Okay. So here, independent, we don't have a choice. In year two, what will come, or there is no chance. In year two, if in year one, the 30% has come, the dependency means that in year two also, 30% will automatically come. So there is a 100% chance. It will be 30% into 100% into 100% into 100% into 100%. Because in year two, there is no probability that best case or base case will come. So hence it is 30%. Okay. Shruti, I just explained. If independent, we are doing 0.30 into 0.30 into 0.35 times. Independent, we are also doing that. So for the dependent case, we are also doing that, but we will not take 30. We will take 100% only. Okay. I hope this is clear, Shruti, Tanisha. So Guram is saying, please explain once the part number 4. Okay, let's go to the part number 4. Okay. See now part number 4, it is saying that you you don't think about dependent or independent. You just think that there are three different possibilities. first, second, and third, because it is mentioned that assuming there are only three streams of cash flow which are represented by each column of the table. So basis that you arrive at the standard deviation and coefficient of variation. So for that, we first have to calculate the NPV, correct? Expected NPV. Hence, we have calculated this expected NPV for all the three different cases and arrived at the standard deviation using our regular formula. Okay, students. Now let's quickly come to the last part of this question. Coefficient of variation of X Limited on its average project, which is in the range of 0.95 to 1. If the coefficient of variation of the project is found to be less risky than average, 100 basis points are deducted from the company's cost of capital. Have we calculated the yes, we have calculated the coefficient of variation. The actual coefficient of variation is 0.90. The range is 0.95 to 1. If it is less than this range, then what happens? Reduce 1% from cost of capital. Wait, Shruti, I will respond to that. Okay. So as far as the last part is concerned, we are on the last part. So the adjusted rate is so the adjusted rate is 10% minus 1%. Sorry, students, which is 9%, right? Sorry. So then we have to just take basis 9%. What is the present value? Year 0, 1, 2, 4, and fifth year. We have already seen that 4 lakh is the first year number. Present value at the rate 9% is 1. The weighted average cash flow for the first 4 years was 1,09,000 per annum. And 3.240 is the 9% present value annuity factor for 4 years. 1,50,000 was basis the salvage value. 0.650 is the present value factor at the rate 9% minus 4 lakhs. 3,53,160, 98,800, 51,960 is the total expected NPV. And hence, the NPV is positive, the project can be accepted. So Shruti is saying, sir, if in independent, it has equal chance of occurring or cash flows are independently, why 0.3 is coming 5 times in my question? Why not in second year 0.2 or 0.5? Okay, Shruti, that is because the question had asked us that you have to give the probability of worst case happening throughout the project. That is why we have not taken 0.2 or 0.5 in the second year. We have only taken 0.3 also in the second year. Mansha is saying in 4 point we took only one stream of cash flows, that is 1,10,000. No, Mansha, we took for calculating the NPV of 1,10,000 case. But while calculating the expected NPV, we have taken all the three cases: base case, best case, and worst case, and even for the standard deviation. Okay, Shailesh, I will explain that. Okay. I hope it is clear till here. So students, what I suggest, let's take a 10 minutes break. It's 8:50 now. Let's again convene at 8:25. Okay. the assignment. So the XY Limited has under its consideration a project with an initial investment of rupees 1 lakh. Three possible cash inflow scenarios are with the probabilities of occurrence has been estimated as below. So this is somewhat similar to the previous question. So there are three different possibilities. The project life is 5 years. Desired rate of return is 20%. The estimated terminal values of the project are also given under the three possibilities. 0 in first, 20,000 in second, and 30,000 in third. You're required to find the probable NPV. So students, it is relatively very simple. We can just simply put, uh, first of all, we can find out the cash flows, correct? So year zero, the cash flow is 1 lakh, correct? 1 to 5, the cash flow is 20,000 into 10%, 30,000 into 70%, 40,000 into 20%. So this comes as 31,000, the yearly cash flow for 5 years. Then for the fifth year, the salvage value 0 for 10%, 20,000 for 70%, and 30,000 for 20%. So this comes as 20,000. Okay, students. So basis this 1 lakh, 31,000 and 20,000, we can compute the NPV. So NPV will be minus 1 lakh plus 31,000 divided by 1.20 raised to the power 1 for first year, second year, third year, fourth year, and lastly, fifth year. Fifth year, simply we can take 31 plus 20, which is 51,000 divided by 1.20 raised to the power 5. Correct? So here the NPV will be 746.52. Okay, students? So Shruti is asking in the previous question why the question is asking to reduce 1%. The simple thing we have discussed in the risk adjusted discount rate, if the project is less risky, the cost of capital also becomes lower. Okay, Shruti? That's the reason. The second part here, find the worst case NPV and the best case NPV. So students, what is the worst case here? The worst case is the basis the cash flows. So this is the worst case. What is the best case? Again, basis the cash flow, 40,000 is the best case. So this one is the best case. Okay, students. So can we calculate the worst case and best case? Yes, we can definitely calculate. Worst case will be the cash outflow remains same, minus 1 lakh plus 20,000 divided by 1.2. Simply 20,000 divided by 1.20 raised to the power 5 plus 0, because the salvage value is 0. Okay, students. So the NPV here becomes minus 40,186. Sorry, it's 187. For the best case, it will be minus 1 lakh plus what is the cash flow? 40,000 for the best case. Okay, what is the outflow? Sorry, inflow 40,000. So 40,000 divided by 1.20 plus. Similarly, 40,000 divided by 1.20 raised to the power 5 plus. And what is the salvage value? 30,000. 1.20 raised to the power 5. So hence it comes as NPV here comes out as 31,680. So this part is also done. Yes, Mancha, 100 bips is equal to 1%. That is right. Okay. Then last part, state the probability occurrence of the worst case if the cash flows are perfectly positively correlated over the period of time. There is a perfect positive correlation. That means they are dependent on each other. They are dependent on each other. If they are dependent on each other, that means if in the first year itself there is a worst case of 10%, year 2 also, year 3 also, year 4 also, it will come as worst case itself. So the probability is 10%. Okay. So this is because the cash flows are perfectly dependent. Because in the first year itself, it goes to the negative, it goes to the worst case. Automatically, all the years, 100% chance that it will go to the worst case. Okay. Okay, students, question number 18. Quickly, Red Limited is considering a project with the following cash flows: cost of plant, recurring cost, and savings. The cost of capital is 9%. Measure the sensitivity of the project to the changes in the level of the plant value, running cost, and savings. And it is also saying consider each factor at a time. That is what sensitivity is all about, right? Such that NPV becomes zero. So they want us to make the NPV zero. Then how we will calculate it? The present value factors are as under 0, 1, 2 factor they have given. Which factor is more sensitive to affect the acceptability of the project? So first of all, for calculating sensitivity, we have to calculate the NPV as is, right? Solution. Year 1, running cost and savings. We're calculating the NPV base case. How much it is? 4,000 into present value factor is 0.917. 12,000, again 0.917. This comes as 3668. This comes as 11,004. Then year 2, running cost and savings. This comes as 5,000 into 0.842. The second year, we have to take 14,000 into 0.842. So this is 4210, and this is 11,788. So the total comes out as 14,914 minus cash outflow. How much it is? 10,000. So this comes as 4,914. So the NPV is 4,914. To make this NPV as zero, we have to do the sensitivity analysis. Sensitivity. So for the plant cost, if the plant cost goes up by 4,914, the NPV will become zero. What is the current plant cost? 10,000. So percentage wise, it has to go up by 49.14 percentage. Increase. Running cost. Running cost also has to go up because the cost has to go up to make NPV zero. 4,914. And what is the total running cost for 2 years at a present value level? So students, please note, you cannot take the year 1 and year 2 values as is. Sorry. So you have to take the present value of year 1 and present value of year 2 to do this comparison. Okay. So how much it is? 3668, 4210. Correct. So this is how much? 62.38 percentage. Then third, savings. Similarly for savings, the savings has to go down. Correct? Savings will go down, then only NPV will become zero because currently NPV is positive. So savings also we will take the present value here. Okay, students? 21.56% say percentage. So it has to fall. Now, students, I want one answer from all of you. Which factor do you consider to be the most sensitive, whether it is plant cost, whether it is running cost, or whether it is savings? According to you, which factor is most sensitive? We have calculated how much change should happen in each of these factors to make NPV zero. Come on, students, please answer. So all the three factors we have put. Okay, everyone is saying running cost. Tanisha. Okay, Devansh is saying savings. Tanisha is saying running cost. Suraj is saying running cost. Manjunath is saying savings. Okay, students, please note that running cost has to change by 63% to make NPV zero. But savings only need to change by 22% to make NPV as zero. That means the most sensitive factor is savings here because it is changing little to create the impact of making NPV as zero. Okay, students. So Shruti, yes, savings is right. Shalish, running cost has to change the highest. That means running cost is least sensitive. Correct? Think it from the other way around. Because the way this question is drafted, it is drafted the other way around in a reverse manner. Okay, Tanisha? Yes, perfect. Perfect, students. Let's go to the next question. We have a lot of questions to cover. Easygoing Company Limited is considering a project with initial investment for a product survival. It is estimated that the IRR is 16%. Student, please note that this question is very, very important and very, very good. Okay. So please, or request all of you to please focus here. So they have given us the IRR of the project. What is IRR? Where present value of cash outflow is equal to present value of cash inflow. So IRR is that rate of return which equates the cash outflow as cash inflow, or in other words, NPV 0, having an estimated life of 5 years. The financial manager has studied that the project with sensitivity analysis and informed that the annual fixed cost sensitivity is 7.841%, whereas the cost of capital sensitivity is 60%. So if cost of capital increases by 60%, the NPV will become zero. The fixed cost will increase by 7.8416, the NPV will become zero. Okay, I hope we are able to read the sensitivity part here. Other information are profit volume ratio is 70%, variable cost is 60 per unit, and annual cash flow is 57,500. Ignore depreciation on initial investment and impact of taxation. Calculate the initial investment of the project. So students, can we make use of IRR? Yes. IRR at the rate of 16% we have been given. That means NPV at 16% will be zero. Correct? So can we say that initial cost is equal to present value of cash inflows? Yes, we can say that. Sorry. What is the present value of cash inflows? 57,500 is the annual cash flow. And for 5 years, PVAF 16% for 5 years. What is that value comes out to be? That value comes out to be 16%, 3.274. Okay. That is given in the table. 57,500 into 3.274. This comes as 1,88,255. Initial cost is okay. So the first part is done. Second part. NPV. What is the net present value of the project? So you have the initial cost, you have the present value of cash inflows. What you don't have? The discount rate, because we have been given the IRR. So if at IRR, NPV is at 0 and the sensitivity is at 60%, can we calculate the cost of capital? Yes. So let's assume let cost of capital, I'm saying let the original cost of capital be X. In that case, 16 is the IRR minus X divided by X is equal to 60%. This is what the sensitivity is, right? If let's say my original was X, so 16 is the rate at which NPV becomes 0 and the sensitivity is 60%, this equation is holding true. So if we solve X, it is 10%. So if 10% increases by 60%, that means 10% goes to 16%, then NPV becomes 0. That means 10% is my original cost of capital. Okay, students. So the NPV of the project will be 57,500 at the rate of present value annuity factor 10% for 5 years minus initial cash outflow, which is 1,88,255. So this will be 57,500 multiplied by 10% for 5 years, students. 3.791. 29,727. This is the NPV. I hope all of you are there with me, students, till now. Third part, annual fixed cost. Now, students, for annual fixed cost, we have NPV, we have sensitivity factor for annual fixed cost. Can we use that? Yes. So let the change in annual fixed cost, which makes NPV 0, is X. Okay. What does that mean? That for all the cash flows, because annual fixed cost is the component included in the cash inflow for the next 5 years, right? So if that happens, then 29,727.50 is equal to 3.791, which is the present value annuity factor multiplied by X. Correct? See, students, what does this giving? This is giving us the present value of change in fixed cost, which is making NPV 0. Correct, students? Mansha, your question is right. Sensitivity can also decrease. But in this case, since NPV is positive already, so the increase in discount rate will always decrease the NPV. Okay. Sorry, where Shruti, where? So it will be 40% to the equation, not 10%. Shruti, please elaborate. Where are you saying 40% and 10%? Okay. So X becomes 7841.60. This is the change in fixed cost. We have to arrive at the absolute fixed cost, right, students? So now the sensitivity is how much? 7.8416 percentage. Correct. So let assume, let original cost be Y. I mean to say fixed cost. Okay, students. So if the original fixed cost is Y, then on that, if you multiply 7.8416, you will arrive at the change, right? So Y multiplied by 7.8416 percentage will be 7841.60. So this value is here, and this value is coming from the sensitivity fact given in the question. Hence, Y will be 1 lakh. So the original fixed cost is equal to 1 lakh. Okay, students, let's come to the next part, estimated annual unit of sales. Okay, next part is annual unit of sales. So students, for calculating the annual unit of sales, first we have to arrive at the total sales value. So for doing that, we have to arrive at the selling price. So selling price per unit is how much? We know that variable cost per unit is there. If we divided it by the cost percentage per unit, that will be arrived how? So this 70% is the profit volume ratio. If 70% is profit volume ratio, 30% is the variable cost ratio, correct? So 60 divided by 30%, this comes as 200. So selling price per unit is equal to 200 rupees per unit. Then we also know that sales value multiplied by PV ratio will be equal to annual cash flow plus fixed cost. Correct, students? Because this will give us contribution and this will also give us contribution. So contribution plus contribution is equal to contribution. Correct, students? Okay. Perfect, students. Then can we calculate, when can we put all the things in this? So we don't have sales value. Sales value into 70% is equal to 57,500 plus annual fixed cost of 1 lakh. So solving this, sales value is coming as 2,25,000, and hence sales in units will be sorry, 2,25,000 divided by 200, which is 1125 units. Sorry. I hope this is clear, students. Yes, Devansh. Yes, Tanisha. Perfect. So I think this question has a good mix of the concepts that you have studied in your, I think, marginal costing and capital budgeting. Okay. Then the last part, the fifth part is break-even units. What do you mean by break-even units? Break-even units is when fixed cost is equated to the contribution, right? So fixed cost should be equal to the contribution. Then you arrive at the break-even. For calculating the contribution, you need to know contribution per unit multiplied by sales unit is equal to fixed cost. Let's put down all the values here. 1 lakh is the fixed cost. Contribution per unit is 200 minus 60, which is 140 per unit. And sales unit is what we have to calculate, correct? So sales unit is equal to 1 lakh divided by 140, which is 714.285 units. Okay, students? Very nice. Good to see Tanisha, Shruti, Devansh. Okay. Yes, Tanisha, answer is correct. 714.29. Very good. Let's come to next question. Question number 20. New projects limited is evaluating three projects, project 1, project 2, and project 3. I hope now it is visible. So project 1, project 2, project 3, following information is available in respect of these projects 1, 2, and 3. Cost has been given, inflows from year 1 to year 4 is given, and the risk index is also given. What do you mean by risk index? Risk index is if market interest rate is 1, then for this project, you have to take 1.8 times. It is as good as beta that you study in your CAPM, capital asset pricing model. Okay, students, it is as good as beta. Find out, okay, minimum required rate of return for the firm is 15% and applicable tax rate is 40%. The risk-free rate is 10%. Required, find out the RADR, which project is the best. Okay. So the first part, calculation of RADR. So students, as per our knowledge on RADR, all of us know that RADR will be risk adjusted discount rate, and the way it has to be calculated should be reflective of the risk index. The risk index is actually used to calculate the RADR. Let us see how. So the risk-free rate of return plus risk index required return minus risk-free rate of return. This is the formula as good as CAPM. So RADR is equal to this much, right? So project 1, project 2, and project 3. Yes, Tanisha, you're right. Beta. Perfect. Good to see responses, students. So the risk-free rate of return is 10%, 10%, and 10% plus risk index is how much? 1.8, 1, and 0.60. Can you see project 1 is highest risky because it is almost 1.8 times the regular project. Project 3 is lowest in terms of risk because it is almost zero point 0.6 times of the overall risk. So 1.8, 1 and zero point 0.6 is clear. Then required return is how much? Required return is 15% minus 10%. 19%, 15%, and then 13%. I hope students RADR calculation and concept is clear. We are able to link it to the required concept. Then next part I'm skipping. Which project is the best? That can be calculated using the present value. This is just a normal calculation. Cash outflow is given, inflows are given, and the RA, the discounting rate we have already calculated. Okay, students? Yes, Tanisha, you're right. 19, 15, and 13. Perfect. So I'm moving to the next question. Question number 21. A firm has an investment proposal requiring an outlay of 80,000. The investment proposal is expected to have 2 years economic life with no salvage value. In year one, there is a 40% probability that cash inflow after tax will be 50,000 and 60% probability that it will be 60,000. Okay. So this has a 40% probability and this has a 60% probability. The probability assigned to cash flows after tax for the year two is as follows. So year two is independent of year one, students. Can you see this? Yes, it is independent because year one, if something comes, then year two have its own different probability itself. Year, in this case, it has some other probability itself. The firm uses 10% discount rate, construct a decision tree for the proposed investment project and calculate the expected net present value. Yes, Manja, systematic risk beta will go there. So 21 question. First of all, we have to construct the decision tree, students. Very easy and very simple. Decision tree, we discussed two things. One is decision node, one is chance node, and third one is the outcome, right? So all of there, what are the different possibilities only we have to plot. Cash outflow, 80,000. Once you do that, first year, there are only two probabilities. What are they? You might get 50,000 or you might get 60,000. What is the probability? 0.40. What is the probability? 0.60. From this 50,000, there are three possibilities. What are they? 24,000, 32,000, and 44,000. Here, 40,000, 50,000, and 60,000. Now, can we also put probabilities? So 24, 32, 0.2, 0.3, 0.5, 0.2, 0.3, and this one has 0.5. Similarly, this one has 0.4, 0.5, 0.1. So students, this is a question on independent probability distribution. So in this case, students, we have how many possibilities? This is 1, 2, 3, 4, 5, and 6. Are there 6 possibilities? Yes. Because first year there are 2 possibilities, then both the possibilities have 3 more possibilities, right? So in totality 6. Can you tell me what is the probability? 1 into 2, correct. Year 1 into year 2, that's what we have studied. If the cash flows are independently related, so here 0.4, 0.2, which is 0.08. Second year, 0.4 into 0.3. So this is 0.12. Like that, 0.20, 0.24, 0.30, and lastly 0.06. In totality, it has to be 1. Just total it, it should be 1. Okay, students? Shruti and Devanshi, yes, you can keep it in the way you are saying. Okay, my point is I'm trying to explain something else over here, which is the independent cash flow. Okay, students? Then next part comes as NPV. So there are 6 possibilities: 1, 2, 3, 4, 5, and lastly 6. So the first one is year 1 cash flows and year 2 cash flows, right? So what are the possibilities in year 1? First node 50,000, 40% probability, which is how much? Sorry, we are trying to calculate the present value, right? So 50,000 into present value factor of 10%, year 1 is 0.909, which is how much? 45,450. It will remain same for the first 3 paths, correct? First year present value of cash flow is this much. Then second year second possibility was 60,000, and again 0.909. This becomes how much? 54,540, 54,540, and 54,540. Now what about year 2? Year 2, absolute cash flow, how much we have? 24,000 into 0.826. Okay, then 32,000 into 0.826, then 44,000, 0.826, then 40,000, 0.826. Fifth one is 50,000 into 0.826 because we are discounting from 2 years. So hence we are using 0.826. Then lastly 60,000 into 0.826. So these values will be 19,824, 26,432, 36,344, 33,040, 41,300, and lastly 49,560. Okay, students. So the total of year 1 and year 2 will be, because these are the present values, hence we can do the total, correct? So it will be 65, 274, 71, 882, 81, 794, 87, 580, 95, 840, and 104, 100. So this is the present value of cash inflow. What is the cash outflow? It is 80,000 across all the options. Okay, I'm not writing. Then can we calculate the NPV in the last column? Yes, we can calculate NPV. 65 minus 80,000, 71 minus 80,000, like that. So respective NPVs we can calculate, correct? So I'm just writing down the NPVs. So first one is minus 14,726. Next one is minus 8,118, 1,794, 7,580, 15,840, and 24,100. Okay, students, there is no need for a total because it is already the respective pathwise NPV. Now, calculation of expected NPV. Again, we will put different paths. Write down the NPVs: 14,726, 8,118, 1,794, 7,580, 15,840, and lastly 24,100. Write down their probabilities, joint probabilities that we have calculated above, correct? 0.08, 0.12, 0.20, 0.24, 0.30, and 0.06. So the expected NPV, just multiply these two columns and the total comes out as 6223.76. This is the ENPV. Tanisha, we have not done that because these are independent probabilities. That's why the probability distribution is independent. Okay. Let's move on. Let's keep on moving on. We have a lot of stuff to cover again today. What is the what net present value will the project yield if the worst outcome is realized? What is the probability of occurrence of this NPV? Can we say what is the worst outcome? Worst outcome, we have to identify which one is the worst. Tell me, students, the worst outcome is this one, correct? And what is the probability? 8%. Both the answers are there, right? Minus 14,276, that has the probability of 8%. I'm not writing the proper English, but this is the answer. Then the second part, it is asking us to calculate the best outcome and probability. Last part is, will the project be accepted? So the third part, what is the best outcome? 24,100, probability 6%. Fourth part, whether the project be accepted. Yes, because the expected NPV is positive. Simple. Yes. Question number 22. Sorry. Now this is on the replacement, students. A and company is contemplating whether to replace an existing machine or to spend money on overhauling it. A and company currently pays no taxes. The replacement machine costs 90,000 now and require maintenance of 10,000 at the end of every year for 8 years. At the end of 8 years, it would have a salvage value of 20,000 and would be sold. The existing machine requires increasing the amounts of maintenance each year and the salvage value which are given as follows. Opportunity cost they have given to us as 15%, whether the company should replace the existing machine. Simple. They are just trying to do a decision at a point of time where they are having two options. One is to replace or to use the existing machine. Even using the existing machine, they have four different possibilities. Okay, students. So first of all, we will calculate the incremental cost on account of the new machine. Correct? The incremental annual cost on account of the new machine. Of new machine. So students, first of all, what is the cost of machine? The new machine. It is 90,000, clear? Then plus present value of annual repairs. Those will be done at the rate of 10,000, right? Into present value factor for 15% at the rate of 8 years is 4.4873. So this comes as 44,873. Right, students? So this is understood. The total cost that will be spent in terms of outflow at a present value level will be 1,34,873. Correct, students? Then less present value of sales, right? Which will be how much? 20,000 multiplied by 0.3269. This is 6538. This will be reduced because this much it will go and reduce your amount 1,20,335. Then, so students, this is the cost of 8 years, right? Sorry. So if you want to calculate the EAC of this 8 years cost into annual cost, sorry, EAC at the rate 8 years will be, we have to just divide 128,335 divided by 4.48. 873. So students, why we are doing is we have to arrive at the yearly equivalent amount so that can be used in the comparison with the existing machine. So 28,600 is the yearly equivalent amount that will be on account of the upgrade to new machine. Okay. Now we can come to our statement showing calculation of replacement. Okay. So in this, we will take the different scenarios, replace immediately. So if we replace immediately, we will put years here. We will put cash flows here. We will put present value factor at the rate of 15% here. And finally, the present value. So year zero, you are going to replace, correct? So you are going to have 28,600 as the first cash flow, as the first cash outflow, and 40,000 as the cash inflow because the salvage value on year zero is 40,000. 1 and 1, 28,600 negative and 40,000 positive. So the total is 11,400. Replace in 1 year. In this case, first of all, you will spend 10,000 on maintenance and you will realize 25,000. So 10,000 on maintenance, 25,000 you will recover, and 28,600 will be a cost. Correct? Present value factor will be 0.870, 870, 870. And we can just simply multiply and calculate the NPV 11, 830 to negative. Similarly, replace in second year. Okay, so you are replacing in second year. You will still incur 10,000 on maintenance first year. You will also incur 20,000 on maintenance in the second year. And you will get a salvage value after the end of second year, which is 15,000 only. So plus 15,000. Plus you will also incur the equivalent annualized cost of 28,600. So this will be multiplied by year one present value and annuity factor, and the rest all will be year two present value factor. So this will be 34,102. I hope everyone is there with me till now. Third option, replace in third year. So first of all, 10,000 maintenance, 20,000 maintenance, and lastly 30,000 maintenance. Correct, students? And salvage value will be only 10,000 plus 28,600, any which ways you will incur for the previous machinery. Okay. 0.870, 20,000 will be 0.756, 30,000 will be year three annuity factor, which is 0.658, 0.658 and 0.658. The total here comes out as 55,799. Then replace in fourth year. This is the last option, correct? So you will again end up having what? 10,000, then 20,000 of maintenance, then 30,000 of maintenance, right? And then I think again 40,000 of maintenance. There is no salvage value here. and you will also incur 28,600 as your ongoing cost. Yes, students. So for first year, it will be 0.870. Next year, it will be 0.756. Third year will be 0.658, 0.572. Fourth year, 0.572. So the total amount is 82,799. Negative. This is also negative. Okay, students. So finally, we will replace immediately. Why? Because NPV is highest. Okay, students. I hope this question is clear. So this question had two problems statement. One is you will invest in a new machine or whether you will carry on your existing machine. No, Tanisha, we should repair immediately, not in 1 year, but immediately, correct? Because immediately the NPV is coming highest. Rest all places NPV is negative. Okay? Yes. Now let's come to question number 23, students. Quickly. A company has an old machine having a book value 0, which can be sold for 50,000. The WDV is 0 and selling price is 50,000. The company is thinking to choose one of the following two alternatives to incur additional cost of 10 lakhs to upgrade the old machine, to replace old machine with a new machine costing 20 lakhs plus installation cost of 50,000. Right. So the overall cost becomes 20 lakh 50,000 here. Both the above proposals envisage useful life to be 5 years, the salvage value to be nil. In both the proposals, you can say that useful life is 5 years and salvage value is nil. The expected after-tax profits for the above three alternatives are as under. Three alternatives are there, right? Old machine, upgraded machine, and new machine. Okay. So tax rate is 40%. The company follows straight line method of depreciation. Assume 15% to be the cost of capital, and they have given you. You are required to advise which alternative is to be adopted. Okay. So we have to calculate two incremental options. One is this to this or this to this. Okay, students. So first one, first of all, let's talk about cash outflow in case machine is upgraded. In that case, how much you will incur? Outflow will be 10 lakhs. In case of new machine, cost 20 lakhs. Installation will happen at 50,000. So the total cost is 20 lakh 50,000. Okay. Plus, what will one more thing which will happen is we will also sell off the existing machinery, less disposal of existing machine, which will give us how much? 50,000. But there will be a tax on that 50,000 at the rate of 40,000 because WDV is 0. Correct, students? So it will give us 30,000. So the net amount will be 20 lakh 20,000. Why this 30,000 is not appearing in the first case? Because in the first case, we are continuing with the first machine. Okay. Self replacement immediately without using 1 year. What is the fun of buying the machine in question 22? No, 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 Guram. We are saying that the existing machine can be replaced with a new machine. Okay, Guram. In the previous question, replace immediately means that new machine you will purchase immediately. Okay. It's not that new machine you will purchase now and then again you will replace the new machine immediately. It's not that. They are saying that existing machine is there. When to replace it, you can replace it immediately. That is the question. Okay. Then, then we can also calculate the depreciation. First alternative is what? Upgradation, right? Upgradation 10 lakhs divided by 5. This gives us 2 lakhs. Second, new machine. How much will be 20 lakh 50,000 divided by 5, which will be 4 lakh 10,000. Correct. So the old machine, there is no depreciation on this because the WDV was already 0. Okay, students. Then second part, we will calculate the cash inflows after tax in both the cases, right? So the first case we are taking for upgradation. Okay, students. So upgradation, what we will do? Year 1, 2, 3, 4, and 5. Okay. What is the old machine cash flows we are getting? Old machine cash flows we are getting at 5 lakh, 5 lakh 40,000, 5 lakh 80,000, 6 lakhs 20,000, and 6 lakh 60,000. These are the old machines cash flow after tax, profit after tax, sorry. Now for the upgraded machine, what all things you will get? First, your earnings after tax is how much? 5 lakh 50,000, 5 lakh 90,000, 6 lakhs 10,000, 6 lakh 50,000, and lastly 7 lakhs. Yes, Tanisha. Depreciation. No, no, no. Wait. Tanisha is saying depreciation should be 20 lakh 20,000. No. The present value of cash outflow is 20 lakh 20,000, but for the depreciation purposes, you will get 20 lakh 50,000, Tanisha. Okay, which is the cost plus installation cost. Okay. The way this depreciation works is the initial cost divided by 5 years, right? Then depreciation. Depreciation will be 2 lakhs, 2 lakhs, 2 lakhs, 2 lakhs, and 2 lakhs. So students, please note this question is unique because in this question you have been given earnings after tax. We have to calculate cash flows after tax. So earnings after tax, if you add depreciation, then you get the cash flows after tax and then incremental cash flow after tax. So cash flow after tax will be plus of these two, 550 plus 2, which is 750. 590 plus 2, 790. Then 810. Then 850. And finally 9 lakhs. So the incremental cash flow will be 750 minus 5. Minus 5 lakhs, I mean 7 lakh 50,000 minus 5 lakhs, which is 2 lakh 50,000. Here also it is 7 lakh 90,000 minus 5 lakh 40,000, which is 2 lakh 50,000. Then 2 lakh 30,000. So this minus this. Then again 850 minus 620, 270. Sorry, 850 minus 620, 230. 9 minus 660, 240. Okay, students. So in this option, you got the incremental cash flows. Similarly, for New machine now we have to calculate. New machine we have to calculate year 1, 2, 3, 4, and 5, right? What are the earnings after tax? Earnings after earnings after tax are 6 lakhs. In case new option is selected, then another 6 lakh 40,000, then another 6 lakhs 90,000, 7 lakh 40,000, and lastly 8 lakhs. Then depreciation we need to add. What was the depreciation? 20 lakh 50,000 divided by 5. 4 lakh 10,000, 4 lakh 10,000, 4 lakh 10,000, 4 lakh 10,000, 4 lakh 10,000. Then cash flow after tax will be adding both these two. 10 lakh 10,000, 640 plus 410, 10 lakh 50,000, 410 plus 690, 11 lakhs, 740 plus 410, 11 lakh 50,000, 8 plus 410, 12 lakh 10,000. Then incremental cash flow after tax. Again, this incremental we have to compare from the existing machinery, right? So 1010 minus 5 lakh. 5 lakh 10,000. 1050 minus 5 lakh 40. Again 5 lakh 10,000. Then 5 lakh 20,000. 5 lakh 30,000. And finally 5 lakh 50,000. Right? Now we have to calculate the present value of both the options, or rather I can say net present value of both the options, right? So we have upgraded machine at one hand and new machine on the other hand, right? Years 1, 2, 3, 4, and 5 again, right? What is the incremental cash flow after tax? What is the present value factor? And what is the total? Similarly, incremental CFAT, cash flow after tax, present value factor, and total. Present value factor will be at what percentage? Whatever is the cost of capital in the question. That is around, I think, 15%, right? So I'm just not putting the numbers. I'm just putting the totals here, right? Incremental cash flows we have calculated in both the options, right? Upgraded machine and this one. So this one comes out as 8,08,680, and the new machine total comes out as 17 lakh 47,930 less present value of cash outflow. In this case, it is 10 lakhs. And in this case, it is 20 lakh 20,000. Correct? So the net amount is minus 1 lakh 91,320. Here it is minus 2 lakh 72,070. Now, our conclusion, whether you upgrade the new machine or whether you whether you upgrade the existing machine or whether you replace it with the new machine, in both cases, the NPV coming as negative. So that means there is no need to upgrade or there is no need to go to the new machine. We can continue with the existing machine. The company can continue with the existing machine. So there is one question from Tanisha. She is saying that why did we added entire 2 lakh to the EAT and why not only the depreciation, why not only the tax amount? So Tanisha, please note, this is the catch in this question because in this question we have been given the profits after tax. Okay. So we can safely assume that whatever is the new depreciation on that tax already is adjusted in these numbers, and hence to arrive at cash flow after tax, we are just simply taking earnings after tax and adding the entire depreciation into it because depreciation is a non-cash item. Okay. I hope Tanisha that part is clear. So with this question is over, I think. Let's see once whatever are the requirements we have solved for it. Assume cost, you're required to advise the company as to which the alternate is to be adopted. So our advice is that company should continue with the existing machine as is, without any upgrade and without any new machine. Okay. I hope this is clear, students. Now let's go to the next question, which is question number 24. Company X is forced to choose between two machines, machines A and machine B. The two machines are designed differently but have identical capacity and do exactly the same job. Machine A costs 1,50,000 and will last for 3 years. It costs 40,000 per year to run. Machine B is an economy model costing only 1 lakh, but it will last only for 2 years and cost 60,000 per year to run. These are the real cash flows. So students, now you can connect your knowledge on the real cash flows. That means these are not inflation adjusted. I mean, these are not having the inflation amounts in these. The costs are forecasted in rupees of constant purchasing power, which is actually what is meant by the real cash flows, right? Ignore tax, opportunity cost is 10%, which machine company X should buy. Okay, so first of all, for arriving at the solution here, we need to first see and compare the NPVs, correct? And before we compare the NPV, after we compare the NPVs, we also need to be following the EAC method in this because the lives are different. Okay. So two machines A and B, purchase cost is 1,50,000 here and 1 lakh here. Life of machines is 3 and 2. Running cost is how much? 40,000 for machine A and 60,000 for machine B. So PVAF for 10% 3 years and 10% 2 years. We are taking both of them differently, right? 2.486, 1.735. So present value of running cost, we can just simply multiply 40,000 with the PVAF of 10% for 3 years, right? We will get 99,440. And here we get 1,04,100. So the cash outflow, the total cash outflow will be 1,50,000 plus 99,440, which is 249,440. Similarly here, B plus 104,100. Sorry. So we get a cash outflow, the total cash outflow. Now, in this case, there is no cash inflow given, hence we cannot arrive at NPV, correct? But we can compare the cost in such a manner that whichever cost is lower, we can adopt that. However, this cost is for 3 years and this cost is for 2 years. So we have to calculate the EAC, which will be 249,440 divided by 2.486. This comes as 249,440 divided by 2.486, which is 100,338. Similarly, here it will be 204,100 divided by 1.735, which is coming around 117,637. Okay. So Hardan Das is asking about the incremental cash flow. We will take up that after this. Yes, Mancha, that answer is correct. So yeah, Hardan Das, so incremental cash flow from the previous question, I think you're trying to ask. So incremental cash flow, we have to calculate in such a manner that we have two options in this question. One is the upgraded machine and second is the new machine. So the upgraded machine, in both the cases, we have been given earnings after tax, right? So we cannot actually take the EAT as incremental CFAT because EAT needs to be adjusted for depreciation. In the old existing machine, there is zero depreciation. In the upgraded machine, there is some depreciation which we have adjusted. So let me go to that statement. So this 550 plus 2 lakh, we have adjusted to arrive at the cash flow after tax. And cash flow after tax of the old machine is 5 lakhs. Hence the incremental cash flow after tax comes as 2,50,000. Okay. Similarly, for new machine also, whatever is the depreciation on new machine have been added to the EAT to arrive at cash flow after tax and hence the incremental cash flow after tax. Okay, Tanisha. Okay, Hardan Das. I hope this is clear. So, basis this, which option you will select, A or B? Definitely we will go with A because A has lower EAC. Okay. Perfect. Now we are left with the last question. Dear students, Trouble-Free Solutions is an authorized service vendor of a reputed domestic air conditioner manufacturing company. All complaint services related matters of AC are attended by the service center. The service center employs a large number of mechanics, each of whom is provided with a motorbike to attend the complaints. Each mechanic travels approximately 40,000 kilometers per annum. TFS decides to continue its present policy of always buying a new bike for its mechanics, but wonders whether the present policy of replacing the bike every 3 years is optimal or not. So they have a present policy of replacing the bike with a new bike in every 3 years, and they're revisiting that policy. Okay. It is of the belief that as new models are entering into the market on yearly basis, it wishes to consider whether a replacement of either 1 or 2 years would be a better option than the 3 year period. So they are just trying to understand whether 1 year or 2 year replacement could be a better option than a third year replacement. The fleet of bike is due for replacement shortly in near future. The purchase of the latest model is at 55,000 rupees. The resale value of the used bike, of the current used bike, okay, is this much. Running and maintenance expenses, excluding depreciation, are as follows: roads and petrol. Using opportunity cost at 10%, you are required to determine the optimal replacement period of the bike. Okay. Now again, students, this is a policy question. And since it is a policy question, there are different time periods involved. We have no other option but to go to the EAC to compare the cost. So we will put three different scenarios, 1 year, 2 year, and 3 year, and then calculate their EAC. So yes, students, solution. Okay. So years. 1, 2, and 3. First, let's take the, sorry, road taxes, the yearly components, then petrol. We will take the total, then present value factor at the rate of 10%. Correct. So these costs are bound to happen. 3,000 for the first year, 30,000 for the petrol, in totality 33,000. 3,000 road taxes for the second year, 35,000 as petrol, and hence 38,000 being total. Then lastly 3,000 and 43,000. 43 plus 3 is 46,000. Present value factor at the rate of 10% will be 0.909, 0.826, and 0.751. So can we arrive at the present value? Yes. 33,000 into 0.909, 29,997. 38,000 into 0.826, 31,388. 46,000 into 0.751, which will be 34,546. So students, please note that these are the standalone present values of the different years while we take. Now for assessing our decision, we need to know that what is the cumulative cost at the end of first year, second year, and third year. So one column we will have to put as cumulative present value. First year cumulative will be same. Second year cumulative will be 31,388 plus 29,997. Okay, which is 61,385. Third year will be 61,385 plus 34,546. So it simply means if I continue till third year, okay, so in totality, I will incur a cost of 61,385 plus 34,546, which is 95,931. Then present value of resale price. This also comes into play. So 35,000 in case I replace in the first year, 21,000 and 9,000, but these are the respective values. We have to convert into the present value. So 35,909, 21,826, 9,000, 0.751. Okay. So the present value of the resale price will be 31,815, 17,346, 6,759. Okay. So the net outflow. So we will have to take cumulative present value plus the minus the present value of resale price, because one is expense and one is income. So 61,385 minus 17,346, 44,039. 95,931 minus 6,759, 89,172. So students, please note that this net outflow is, let's say we decide to continue for 3 years, then we will have a present value of 89,172 as a net outflow, because we have added 3 years petrol and road taxes and reduced it from the third year realization that we will get, all at present value. Now statement showing EAC for different options under comparison. Okay. Options were replace in 1 year, 2 year, and 3 year. Correct? What is the purchase price? 55,000, 55,000, and 55,000. Net outflow that we have calculated above will be, in case we replace in the first year, it will be 1818. That means it is a income, right? Because our resale value will be higher in the first year. So it is 1818. Then second year, 44039. Third year, 89,172. So total outflow will be 55 plus minus 1818, which is 55,000 minus 1818. It will be 53,182. Okay. Then 99,039. And lastly, 144,172. PVAF at the rate of 10%. So here we will use the annuity factor, right, students? Because we have to calculate the EAC, correct? 0.909, 1.735, and lastly 2.486. So the EAC will be total outflow divided by PVAF. First 58,506, 57,083, 57,993. What is required from the question? The question is asking us to determine the optimal replacement period of the bike. So the optimal replacement period of the bike is 2 years because it is minimum EAC at 57,083. Manisha, that is not asked in the question. So let's stick to what is asked in the question. Okay. There is no requirement for up to 1 year. Okay. So this is what it is. I think we have covered roughly all the questions, not roughly, but fairly. Okay. So I'll just spend 5 more minutes on just revising the entire flow and then we will conclude. Okay, students. Meanwhile, if there is any query which is unanswered, I request please, to put it again so that we can take it up for the same. So students, advanced capital budgeting is actually the advanced version of the capital budgeting that you have studied in your inter. So this involved certain complex issues, for example, inflation, in which we said that the nominal and real has to be understood. Nominal is something that includes inflation and real is something that excludes inflation, whether we talk about interest rate or whether we talk about cash flows. And we also said that there are two ways to calculate inflation. One school of thought is nominal interest rate is reduced. Real interest rate is reduced from nominal. And second is we take a division here. Correct? Mostly used and the appropriately used is the division method. Then we understood that how inflation plays a role in determining the estimation of the cash flows. And we also quoted that if the cash flow is real, then accordingly the interest rate also has to be real. Then we further went on to discuss about the changes in technology. We understood with this example that how changes in technology can help the capital budgeting related decisions as well as the government policies. Government policies, we discussed two things, fiscal policy and monetary policy, which we discussed in detail, and the same can be taken up from the study material to understand and retrieve on the theoretical part. Then we also studied, then the next part we studied in the risk, how to deal with the risk in the entire capital budgeting. So that discussion we started from the certain risk and uncertain definitions. Certain, we said that certain thing which is 100% bound to happen. Risk is something we said that which have possible scenarios with probabilities attached to it. And uncertain something which is we cannot even estimate, in which we said that, for example, we are going with a new product launch. In that case, the cash flows will be uncertain. Then we studied that if we want to achieve the risk and the expected value, we said that standard deviation and mean are used from the statistical standpoint. And then we introduced the techniques to evaluate the risk. The first was probability, where we said that probability is used in calculating the mean and standard deviation. Today, in our questions, we advanced that discussion in terms of the independent and the dependent uh, probabilities for the different multiple period questions. Then second, we went on for the variance and standard deviation discussion, where we said that variance and standard deviation is a measurement of risk, and the topic of coefficient of variance, which is linked to this topic. Then next, we discussed about the risk adjusted discount rate. Risk adjusted discount rate, we said that if higher the risk of the project, higher should be the discount rate. Similarly, certainty equivalent approach deals with the adjustment of cash flows in case of the different risk elements in the project. There we studied about the CE, coefficient of certainty equivalent, which measures the guaranteed cash flows divided by the total cash flows. We compared what are the differences between RADR and CE. So CE actually reduces the cash flows. RADR increases the discount rate if the risk element is high, and hence both of them has the effect of reducing the NPV. Then finally, we went on with the sensitivity and scenario analysis. So sensitivity, students, we discussed that if capital budgeting is a model, there are different types of inputs. What is the change in input that will lead to the change in output, and what is the measure of that? That is given by the sensitivity. Today, we solved certain questions on sensitivity as well. Scenario, we said that if let's say more than one variable change at a time, that is a different scenario, and hence this comes under the scenario analysis. Sensitivity, one change of variable at one time. Then we studied about simulation. I'm not repeating the simulation again because we have studied and built upon our discussion through use of random numbers, through use of the exogenous variables and parameters. And we discussed about one of the question that is given our study material basis that decision tree analysis. We discussed how different possibilities can be carved out in particular decision tree, and today also we solved one of the question here. Okay, so Tanisha is saying yes. So sorry, she's asking that these questions are from the module. Yes, all these questions are from the study material only. Okay, Suraj, these questions are from the study material, and the assignments were already uploaded. Okay, so this was the decision tree, and the last topic was the replacement cycle, for which we have did today enough questions. So one thing to be kept in mind is, if let's say we are talking about a policy decision, so we have to always compare a EAC there. And if we are trying to calculate the point in time cost, then we can compare the absolute NPVs. Yes, Mansha, price after recognizing inflation is the nominal rate, nominal price. So we cannot comment whether real rate or nominal rate is useful. That depends. Both of them have different objectives. Both of them have different uses. Okay. Yes. So I think that's all, students, from my end. I request C. Ashish sir to conclude the session and provide us the concluding.
Thank you,
Thank,
Divas.
thank you,
I
sir.
think you have gone through with the topic of advanced capital budgeting decision. So now topic is over now.
Yes, sir. Yes, sir.
Okay. Okay, student. Well, this topic is basically newly introduced in the new scheme, because earlier this topic was in intermediate level. So now this topic has been introduced here. So of course, Divas sir has explained it in a very elaborative manner. I will say elaborative and very in a good manner. And one student is saying, sir, she is feeling like that it is a fast track classes. Student, is not that. Our classes are basically content oriented. We whatever with the contents important, and very relevant contents that are only discussed in our class. So it is not a fast track class, it is a regular class, of course, but I'm very happy that you said you are catching it up. So I hope other students are also catching up the same. And as you know that we also want to, if you have any query, you can email to us. You can send your query to on a mobile app, or you can contact us. Of course, just they will share my number
Yes, sir.
0120
0120. Yeah.
3045 956. Our 0120 is basically STD code, and you can contact me over there. Now, student, I think Divas, you have done very wonderful thing. I think since portfolio management will be taken by you also, so I think you have done your completed half work, because you have make understood a student the standard aviation
Yes, sir.
and variance, etc. So
Yes,
I
sir.
think you will need less hard work there,
Yes,
because
sir.
student, please note that here we were taking the in standard aviation we were considering the capital cash outflow, etc., or what is the NPV, etc. There in the portfolio management, the method will be the same. Only the values will be from the stock. Value will be the stock return. Okay, everything will be same. So I think at that moment of time, the Devas will not to require much of more time to explain you.
Surely.
So with this, we come to the end of this session. And student, we in the next class we shall start with a new topic, that is security analysis. Okay. So Devas, thanks a lot for sparing your precious time and
Thank you.
enlightening the student on the some this typical topic. And if student is saying, no, no, better, no, it's nothing like disrespectful. It is not you are student, you are our student. You have a full right to ask me your 100 queries. Student, I, from the bottom of my heart, I always say there is no query is a uh, disrespectful query or foolish query. You are free to ask me any queries. In a board of studies, I always welcome students. Please ask me any query, but provided the query should be you are based on your homework, because first you do your homework. If I have a query, please do ask her. Don't hesitate to ask her any query. Okay, students, have a you have thanks for your patience listening. See you in the next class. Thanks a lot.
Thank you. Thank you, sir. Thanks a lot. Thank you.
Okay, okay. See you.